Well, for the first 2 weeks of the year, expectations were that the Federal Reserve would cut interest rates in March, but a reversal of the target rate probability now showing the first rate cut of the year may not come until May. Joining us now, Michael Green, Simplify Asset Management Chief Strategist. Hey, Michael.
Hey, how are you doing?
The market might have changed that, and there were all these warnings that, the market was getting wrong, and they needed to push back their expectations. Okay, so now they've changed their expectations and stocks are still rallying. It doesn't seem to have been a problem here. So does the timing of that first cut matter for equities?
I don't think the timing of the first cut matters per se for equities. I think equities have demonstrated that they are largely insensitive to the change in interest rates. We've seen some areas like utilities that have suffered from much higher interest rates. But the reality is we went into this narrative saying that valuations for stocks were very high because interest rates were low. And now, of course, now that we've hiked interest rates, valuations are higher. So we have to acknowledge that there was something broken in that model. Ultimately, I think it has much more to do with the dynamics of just simply flows into investment vehicles rather than some idea of some discounted present value that the market is trying to price in.
And Michael, I want to get your take on, Julie, we were talking at the beginning of the show about this, about how the narrative seems to have shifted, at least for some, Michael, that we had any number of smart strategists. It wasn't that long ago saying, they were betting on 2024, the equity market was going to run higher, and the story was, well, the Fed's going to cut early, and this participation is going to broaden out. As we were chatting, Michael, now markets more skeptical that they're going to cut early, they're going to cut in March, and really we're back to just talking about tech, but the market seems to want to keep moving higher. How do you think about that, Michael? What explains that? Does that just come down to, economic data keeps coming in stronger than expected? Is that it?
Well, I think the economic data has come in stronger than I think many people had anticipated, given kind of expectations for a recession. But we have unquestionably seen things like hiring slow down dramatically. Job openings are slowing down dramatically. We are seeing corporate profits that actually, in aggregate, disappointed for 2023, despite the fact that you had a huge rally. And now, of course, we're expecting end of year 2024, roughly the same level of earnings that we expected at the end of 2022. So I'd suggest it has much less to do with fundamentals. It has much more to do with the actual underlying dynamics of how trading is done today. We have an incredible supply of short volatility. People are selling call options. When those call options mature, they're ultimately forced to buy back those positions. Dealers are hedging, et cetera. Those dynamics lead to this kind of slow, continuous melt up. And in the background of all of this, we just have the share buybacks coming from those large tech companies that are continually propelling their shares higher, while the rest of the market is really struggling in many situations. Looking at 2024, today is the exception with the Russell 2000 up sharply. But year to date, we've had terrible experience across many sectors with, many of the stocks that were up strongly in the fourth quarter of 2023 now down anywhere from 10 to 15%.
So, Michael, if there are these sort of underlying dynamics that are supporting the market overall, but you have these weakening fundamentals inside, like what is going to be the thing that flips the switch, if anything?
Well, I think you used exactly the right phrase, flip the switch, right? It is you have to actually cross over that point, right? Kind of playing with the switch and pretending to flip it is not going to turn the lights off. It's when you actually flip it. And I think everybody at this point is broadly acknowledging that the key really is the labor market, which has remained very strong in terms of unemployment and the number of employed individuals. If that starts to deteriorate, then we could actually start to see things like 401k flows, retirement flows, et cetera, move significantly lower. And then the other component, of course, that's paradoxical to, I think, a lot of people is that the Federal Reserve, having hiked interest rates, that's sending an unbelievable amount of income out to the older generation. That means they don't have to sell their stocks or harvest their stocks. They can now generate returns off of their cash balances or investments in fixed income that they couldn't have done 2 or 3 years ago. And so paradoxically, if the Fed cuts interest rates, we could actually see a deterioration in that household income that is currently being supported by those Fed hikes that's driving the deficit to such extraordinary levels.
And Michael, one point, you bring up, listen, there's a lot of cash on the sidelines. There's trillions of dollars sitting in money market funds and CDs. If the market keeps grinding higher, though, Michael, is that a potential tailwind for the equity market here in 2024?
Well, I think that's the key question. Do we actually see people aggressively try to move that money out of cash balances and into the equity markets? the perennial cash on the sidelines argument runs into this narrative of, well, there's always going to be cash on the sidelines because every buyer has a seller. The simple reality is if those buyers get very aggressive, if they decide that with the Fed cutting interest rates, that maybe they need to move back into equities, then they'll pay higher prices and the markets will advance. But in the meantime, people are just continue to steal a phrase from the crypto world, stack their dollars and benefit from that sweet, sweet interest rate.
The sweet, sweet interest rate, keeping people out of equities for now. Michael Green, thank you so much. Appreciate it.
Thank you.